In less than 48 hours, the world's reserve currency started behaving like a risk asset. 8%. For a currency benchmark that usually creeps, that's a jolt. And it matters because the dollar is not a local instrument. It is the yardstick for oil contracts, the settlement language for trade, and the collateral backbone of the global financial system. When that yardstick suddenly shrinks, everything measured against it starts to wobble. They said this kind of shift couldn't happen without a shock. Not months, not weeks. In 48 hours, the trend narrative started to crack anyway. That is what makes this moment dangerous and fascinating. Because the first move is almost never explained in real time. Institutions already have models for what comes next. They already know where the pressure points sit. Most people only hear the story after the market has voted. And here's the pattern interrupt. The dollar didn't slide because a single official admitted defeat, or because a dramatic emergency cut hit the wires. It slid as rate cut bets quietly thickened, and as the world's biggest allocators began speaking about reducing U.S. exposure as a normal portfolio decision, not a protest. That combination can change everything, because it attacks the two pillars that held the dollar up: yield advantage and global default allocation. Welcome to Roki Studio Finance, where we decode what matters before it becomes the headline everyone repeats. If you like calm, evidence-first breakdowns, stay close, like listening to that wise elder who never shouts but always points at the numbers. And drop a quick comment with where you're watching from, because currencies connect every country in the chat, whether we notice or not. Now let's reconstruct the event with forensic detail. 8. That level is not magic, but it is symbolic. It drags the dollar back toward the pricing environment of early 2022, before the peak rate narrative became the dominant story of global markets. In 2022, the Federal Reserve moved aggressively as inflation surged, and the U.S. yield advantage widened. The dollar rose because higher relative yields pulled capital in, and because in uncertain times, the world defaults to the deepest pool of collateral. This week's move mattered because it looked like a vote that the peak rate chapter is ending. Market pricing, expressed through rate futures, has been assigning meaningful odds that the Fed will cut rates in 2026, and not just once. In late January, probabilities were being discussed in a way that implied multiple possible cuts. Roughly a 32% chance of 2 cuts in 2026, around 25% odds of 1 cut, about 22% odds of 3 cuts, and only a small slice, near 8%, implying no cuts through year end. That's a wide distribution of outcomes, and wide distributions create volatility. Then came the contradiction. Now, while rate markets leaned toward easing, at least one major bank voice argued the opposite, pushing a zero cuts view for 2026. That is not a small disagreement. That is two institutions looking at the same world and telling completely different stories about what the Fed can do. When that happens, currency trends can turn before the debate is settled, because currency markets trade the change in expectation, not the final verdict. At the same time, the flow story got louder. 4 trillion euros, said it expected to reduce exposure to U.S. assets over the coming year, explicitly pointing to dollar weakness and the need to diversify. That statement is a flare. It tells you that portfolio committees are not just watching the dollar, they are treating dollar direction as a central input into allocation, and when a portfolio of that size changes at the margin, the market feels it. So the central mystery becomes clear. Is the dollar dropping because rate cut bets are rising, implying a shrinking yield advantage? Or is the dollar dropping because large global investors are rebalancing away from U.S. assets, implying a structural flow change? To see why, you have to understand the hidden pattern. The dollar moves in regimes. In a strong dollar regime, the same forces reinforce each other. U.S. growth holds up, U.S. yields lead, risk capital prefers U.S. assets, and the dollar strengthens, which in turn tightens global financial conditions and pulls more capital toward the perceived center. In a weak dollar regime, the reinforcing loop runs the other way. Relative yields stop widening, global growth outside the U.S. becomes more competitive, allocations diversify, and the dollar weakens, which loosens global financial conditions and encourages more risk-taking elsewhere. We've watched this play out across decades. In 2001 and 2002, after peak tech exuberance faded and the rate cycle turned, the dollar began a multi-year decline. It did not move in a smooth line. It produced sharp counter-trend rallies, then resumed its slide as capital flows and relative growth expectations shifted. In 2008, the dollar surged during the worst phase of the crisis because the world needed the safest collateral, then weakened as policy support expanded and risk appetite recovered. In 2020, the dollar spiked as the world demanded liquidity, then drifted lower as extraordinary. Easing rewired the system. If you want a clean historical marker for a strong dollar becomes too strong moment, look at 1985. The dollar had surged for years, helped by high U.S. rates and capital inflows, until policymakers and markets accepted that the strength was distorting trade and growth. The Plaza Accord became a visible sign, but the underlying driver was already there. The system was searching for balance. The dollar weakened materially over the following years. The key lesson is not the agreement itself. The lesson is that once a strong dollar regime loses political and economic tolerance, the trend can unwind for longer than people expect. Now bring that back to today's setup. The data calendar is loaded with catalysts that can support opposite narratives. Payroll expectations have been discussed around a modest figure, near 70,000, which would tilt conversation toward cooling growth. 3% month over month, which can be interpreted as stable but still persistent, depending on what the prior trend was. Those numbers are not extreme, and that is what makes them powerful. They leave room for interpretation, and markets in interpretation mode are markets in volatility mode. The first player is the Federal Reserve, not because it has declared anything new, but because expectations about its next steps directly change the valuation of nearly every dollar-priced asset. The second player is the futures market, where those expectations are expressed in probabilities that update daily, sometimes hourly. A small change in pricing can force hedges to adjust, and hedges move real money. Then there are the allocators. Asset managers, pension funds, sovereign wealth funds, and insurers carry mandates that prioritize risk-adjusted returns over patriotic narratives. If the dollar has fallen more than 10% over the past year, a foreign investor holding U.S. assets feels that. Even if the U.S. equity market performs well in dollar terms, the translated return can look weaker in euros, yen, or pounds. Over time, that math changes behavior. It increases the incentive to hedge currency risk, and it increases the incentive to diversify where future returns might not be penalized by currency translation. Hedging is not a vibe, it is a cost. And that cost is linked to interest rate differentials. When U.S. rates are high relative to other rates, hedging dollars can be expensive for foreign investors. That can discourage hedging and keep foreign capital exposed to dollar direction. But when the market begins to price Fed cuts, that differential can narrow and hedging can become less painful. The moment hedging becomes easier, institutions can reduce dollar risk without sacrificing as much return. That is how a rate narrative becomes a flow narrative. This is where the dislocation becomes undeniable. Two smart money systems are pointing opposite directions. Rate markets are assigning meaningful odds to multiple Fed cuts. A major bank narrative is arguing for no cuts. Meanwhile, a giant asset manager is saying it plans to reduce U.S. exposure, citing dollar weakness. These signals do not align neatly. And markets hate misalignment because misalignment creates forced decisions. Think of the dollar as a lever. When it moves, it shifts global commodity prices, the debt burden of dollar borrowers, the competitiveness of exporters, and the translation of multinational earnings. When the lever moves quickly, other parts of the machine move too. That's why the dollar's trend is not just a chart, it is a transmission mechanism. There's a reason this kind of turn can feel sudden. Currency markets often move when expectations shift at the margin, not when the absolute level of rates changes. Think about what the probabilities imply. That widening matters because hedging desks, macro funds, and treasury managers don't wait for certainty. They manage risk to distributions. And the disagreement between the futures curve and the no-cuts research view isn't just a forecasting contest. It is an exposure contest. If you're positioned for a stable or strengthening dollar, the easiest way to justify that position is to believe the Fed will not cut. If you're positioned for a weakening dollar, the easiest justification is to believe cuts are coming. Both camps can find data points to support their case, especially in a year where inflation can look steady on a monthly basis while growth shows pockets of softness. This is why the period ahead becomes so sensitive to sequencing. If inflation surprises to the upside first, it strengthens the no-cuts story and can spark a dollar bounce that forces some weak dollar positions to cover. If growth slows first, it strengthens the cut story and can extend the downtrend. The sequence can create whipsaws that feel irrational, but they are rational responses to changing probability weights. Now zoom into the plumbing. The dollar index is a basket, and baskets hide as much as they reveal. A slide in DXY can be driven by strength in the euro, the yen, or a mix of both. That matters because each counterpart currency has its own catalysts. A stronger yen can reflect shifts in Japan's yield outlook, risk sentiment, and political or policy expectations. A stronger euro can reflect relative growth expectations, policy divergence, and capital returning to Europe. When the dollar weakens across multiple counterparts, it suggests the move is less about one rival's strength and more about the dollar's own regime. That's where institutional commentary becomes even more powerful. When a global asset manager says it plans to reduce U.S. exposure, it is not only about the dollar index. It is about the relative attractiveness of U.S. equities, U.S. credit, and U.S. duration versus alternatives. It is also about concentration risk. Over the past decade, U.S. assets became the default overweight in many global portfolios. And crowded trades do not need a new crisis to unwind. They just need a better alternative and a plausible reason to rotate. You can also see the pattern in how narratives change language. Early in a strong dollar regime, commentary focuses on U.S. resilience and global fragility. Late in a strong dollar regime, commentary begins to focus on U.S. valuation, fiscal questions, and the opportunity cost of staying concentrated. That linguistic shift is not cosmetic. It reflects a shift in what investment committees are willing to say in public. This is also why the term diversification should be taken seriously. Diversification sounds boring, but in currency terms, it can be forceful. Diversification means selling dollars to buy other exposures. It means choosing not to reinvest all proceeds back into U.S. markets. It means hedging dollar risk on profits that would have been left unhedged before. Each of those actions is a flow, and flows can outmuscle data in the short run. A single economic report can move markets for a day. A sustained reallocation can move markets for months. That's why the most revealing moments are when the dollar fails to rally on data that would usually lift it. If a solid U.S. number arrives and the dollar can't hold a gain, it hints that supply is waiting above the market. It hints that there are sellers using strength to reduce exposure, not buyers chasing momentum. Now let's connect this to market dislocations beyond FX. One common dislocation in dollar turning points is between rate expectations and risk asset behavior. Sometimes equities remain optimistic while the currency market becomes defensive. Sometimes credit spreads stay calm while the dollar starts to slide. These mismatches matter because they can't persist forever. Either the currency move is overstating the shift, or the other markets are underpricing it. The reconciliation usually comes through volatility, not through a gentle meeting in the middle. Another dislocation can show up between official narratives and realized positioning. Officials might sound steady while futures pricing shifts daily. Analysts might argue for stability while big allocators quietly adjust. That's not deception. It is timeline difference. Institutions operate on longer timelines. Markets price continuously. The gap between the two creates opportunity and risk. So when you hear rate cut bets are pressuring the dollar, translate it into mechanics. It means forward curves are shifting. It means the expected carry from holding dollars is declining. It means hedges are being recalculated. It means the premium the world has been paying for dollar assets is being questioned. And when the premium is questioned, the trend can change faster than the consensus expects. Late in a regime, confidence gets loud, and that volume often marks the moment the trend becomes suddenly vulnerable. Now comes the part that feels uncomfortable, but is crucial. Once a dollar downtrend is established, it can feed back into the data. A weaker dollar can push import prices up, affecting inflation measures at the margin. It can also support export competitiveness, affecting growth. Those effects are not immediate and not uniform, but they are real. That means the market can price Fed cuts, weaken the dollar, and then see inflation stay firmer than expected, complicating the cut narrative. That is how dislocations persist longer than anyone wants them to. There is another layer that gets missed. The dollar is also the world's funding currency. When global investors borrow in dollars to buy other assets, the dollar can strengthen in stress because borrowers scramble to cover. When funding pressure eases, the dollar can weaken as those positions normalize. A shift from higher for longer to cuts are coming changes the cost of leverage and the incentives to keep funding trades in place. That is why rate cut bets can translate into currency moves even before the first cut happens. Now, how is this executed in real markets? Usually, it looks boring at first. A portfolio committee increases its hedge ratio by a few percentage points. A pension fund rebalances, trimming an overweight in U.S. equities and adding to non-U.S. exposure. A corporate treasury desk adjusts forward hedges because revenue guidance has changed. A sovereign fund reduces the marginal pace of dollar purchases. No single action is dramatic. But if many large balance sheets make the same small decision around the same time, the aggregate becomes powerful. Here's an analogy that makes the mechanism clearer. Imagine a crowded stadium where everyone is sitting. One person stands to see better. People behind them stand too, not because they want to, but because they have to. Soon, the entire stadium is standing, and nobody remembers who started it. In markets, currency regimes can behave the same way. Once a few large players shift hedges and allocations, others follow to avoid lagging benchmarks. Momentum forms, not from emotion, but from incentives. That also explains why you can get the strangest price behavior in transition periods. One day, the dollar rallies on a strong number. The next day, it sells off even on decent data. That does not mean the market is broken. It means multiple forces are competing. Macro surprises, positioning, and flows. In that environment, the clean relationship between rates and the dollar can weaken. The flow story can dominate. So let's anchor the evidence with the numbers that matter. 8 matters, because it is a retreat from the post-2022 strong dollar zone that had been supported by a widening yield advantage. The rate probabilities matter because they show the market distributing weight across multiple easing scenarios, including meaningful odds for 2 and 3 cuts in 2026. 4 trillion euros, which is not the kind of balance sheet that speaks casually. Put those together and the logic tightens. Currency markets are relative machines. They do not care whether U.S. rates are high in isolation. They care whether U.S. rates are expected to stay higher than peers and whether that advantage is widening or shrinking. In 2022, the advantage widened rapidly. The dollar rose. If 2026 becomes the year the advantage is perceived to shrink, the dollar's support weakens. This is why the forward analysis must stay grounded in history and mechanics, not predictions. Historically, when rate cut expectations rise and global allocators begin reducing U.S. exposure, three broad paths tend to appear. In a conservative path, the dollar continues to drift lower in a choppy range. It makes lower highs, tests support, and snaps back on every hawkish surprise or risk-off wave. In that path, the trend changes slowly, and the market spends months relearning what normal looks like without peak rate tailwinds. In a moderate path, the dollar breaks beneath a widely watched support area and forces a broader repricing. In that environment, you often see emerging market currencies respond more positively, commodities firm in dollar terms, and global equity leadership rotate, not because any one move is guaranteed, but because the pricing rail has shifted. In an aggressive path, the dislocation resolves violently through positioning. That can happen if the market prices cuts more aggressively, the Fed becomes more open to easing, and institutional diversification accelerates together. The result is not a straight collapse. It is volatility, with fast moves that feel like overreactions until they become the new baseline. What would help identify which path is developing? Watch what drives the story, not what sells the story. Watch rate probabilities after inflation prints and payroll releases.